Welcome to the weekly market intelligence report for biofuels. I'm George Morris, and I have our senior analyst team, Tori Alden, Ryan Standard, and John Cusick here to answer your questions and go through this week's MI report. With that, we're going to kick it off first with John Cusick. John, would you like to take us through the RINs for us?
Yeah, absolutely. I think I'll touch on just some of kind of the macro winds blowing right now. Obviously, another week of big, strong low carbon announcements from major refiners, BP notably targeting sort of a bit of a slightly unclear net zero emissions goal. You also had JP Morgan talking about continued divesting from fossil fuels and the new channels into renewables that they're currently pushing money towards. In addition, obviously, we've got the macros of the coronavirus, which will be touched on by the other analysts and myself, but that's sending markets downwards in general coming out of the week. So although the forecast is a bit on last week, it's important to touch on that. There's some real volatility right now starting to appear around this sort of macro global situation. So coming down to the RIN market, in the last week, we've had a spread that was arguably supportive of the sort of lower tentative D4 RIN values we've seen out of the last week. Different than what's been happening in the D6 ethanol RINs, which have been sort of straight up across the past week plus now, based on what is SRE news, essentially small refinery exemption information coming out that suggests that the small refinery exemptions that have taken big bites out of the overall demand for RINs of the RFS2 program may be reduced quite a bit, thus creating higher demand for RINs in result. So we saw that news come in. That's pushed the D6 market up, but we've seen the D4 sort of hold its ground. We think the spreads kind of held that back, and we also had some first EMTS news for January, and that was a bigger number than the prior year. And I think, George, I'll dish it back to you to give that to Tori to go with from there on to the EMTS. But nearby, we're still constructive. We're bullish near term on the D4, all vintages. And we see the nearby, even though the markets are sort of coming down on the spread, we believe that SRE news and demand will still drive that a bit higher in the coming week. Back to you, George.
Thank you, John. I appreciate that. And for the attendees who've jumped on, if you have any questions, please submit them in the Q&A section of the webinar, and we'll be sure to address them when we're done going through our material here. With that, Tori, going back to you on the biofuels area.
Thanks, George. So this week or last week, we got the monthly EMTS data from the EPA, and as John alluded to, production was stronger than even we expected and stronger than it was last year. So on D4, total RIN generation was 189.9 million gallons. That was 12.3 million gallons above the Jacobson's forecast and a little bit more than 20 million gallons above the total reported last January. For D5 production, that jumped up to 15.3 million gallons, which was a whopping 6.2 million gallons above the Jacobson's expectation for just over 9 million gallons, and almost double, or more than double actually, the 7.4 million gallons that were reported last January. D6 was, the total was 1.24 billion gallons. Remember, D6 includes ethanol. That was the only category that was actually below our expectations. We had pre-report estimates of just over 1.3 billion gallons, so that was 68 million gallons above our pre-report expectation, but it was still above the 1.19 billion gallons that were produced last year. Just kind of breaking it down a little bit more quickly, domestic biodiesel production was 116 million gallons. That was above 107.7 million that was reported for last year, and that implies that the EIA will report a January total of 147.5 million gallons when it releases its monthly biodiesel production report at the end of May. Renewable diesel production was 41.5 million gallons. That was up from 36.5 million last year and was just above our pre-report estimate of 40.8 million. We also had increases in biomass-based diesel imports. Those were reported at 13.7 million gallons. That was up almost 2 million gallons from last year and about 4.8 million gallons from the Jacobson's pre-report estimate of 8.9. While a lot of these categories are well above our expectation, we're going to hold off on making any adjustments to our annual report until we get a little bit more information. I think the question here before this first set of numbers was how quickly would the industry come back after the blender's tax credit. Now we have a little bit more sense of that, but it's probably will take another month or two before we actually confirm that January just wasn't sort of abnormally high because people were really excited about the blender's tax credit, and this trend will continue. With that, I'll send it back to you, George.
All right, Tori. Back to the attendees. If you have questions, drop them in the Q&A section. We're going to go right back to you, Tori, because you got veg oils to go ahead and tackle. So let's have you tackle that.
Okay. We're going to focus mostly on soybean oil this week because we got the USDA's first look at the 2021 marketing year that wasn't part of their long-term projections. In other words, a forecast for 2021 that was based on the starting point of the WASDE for 1920. Basically, the theme of the 2021 balance sheet at the Outlook Forum was a continuation of relatively tight ending stocks. So USDA's 1920 balance sheet in February suggested that ending stocks will be like 1.52 billion pounds. Their initial 2021 is 1.55 billion. And so you see that that's going to be relatively tight compared to 1819 was 1.78 and in 1718 was just under 2 billion. And so this tightness continues. Now the long-term projections that we got last year suggested that this continues for a year or two and then we start to build stocks again. I have my doubts about that, but right now we're just going to kind of focus on what's going on in 2021. The other changes that they made from their 1920 balance sheets were an increase in soybean oil usage and biodiesel production that jumps from 8.2 to 8.5 billion gallons. And they left their non-biodiesel domestic usage relatively unchanged. Right now, for 1920, they're at 14.9, and for 2021, they're at 15. Remember that USDA includes all biofuel production that's not biomass-based diesel in their non-biodiesel usage forecast. And so there's a big difference in the USDA's outlook for non-biodiesel usage and ours. The Jacobson is projecting non-biodiesel usage of 15.6 billion gallons for 2021. Our biodiesel forecast is just a little bit above USDA's. We're at 8.8 billion gallons versus their 8.5, and so not that much difference. Where there is a pretty big difference is in exports. Obviously, as biofuel demand ramps up, exports are going to fall because basis levels are going to increase. Since we don't crush soybeans for soybean oil, we crush soybeans for soybean meal and then try and figure out what to do with the oil. So USDA cut their export forecast 300 million pounds from 1920 to 2021, dropping it from 1.9 billion to 1.6 billion because of the relatively larger use of in the biofuel industry. our export forecast is down at 1.25. And so while USDA's ending stocks are 1.55 billion, the Jacobson's a little bit lower at 1.34 billion. They also didn't change their average price for Decatur. That is 30.5 cents, which was unchanged from their long-term projections, actually down from their 1920 projections, and well below the Jacobson's forecast of almost 35 cents. All right, with that, I think that's enough for right now. I'll send it back to you, George.
All right, thank you, Tori. Ryan, we have you to cover the low CI section. Would you like to start that off?
Yeah, be happy to dive in here. So we've seen a really strong DCO, or distillers corn oil market, over the last 6 weeks, coming off of the holiday break. Just like the other low CI feedstocks, we've seen tight positions from the buyer side meet a well-sold market, and that continues. I think there's some anxiety over availability in April. That's typically the time for ethanol plant slowdowns, shutdowns. And so some buyers are putting on longer positions at steady prices despite the weakness in the corn and the soybean oil markets. Additionally, there's some thought out there that these IRS payments are going to come and revive some of these idled biodiesel plants, which will help the local truck market for the distiller corn oil sellers. We do expect a little bit of a downturn in the second quarter due to people getting caught up, supply and demand balancing out, and maybe an overcorrection to the upside, falling down to a more reasonable level. With that said, we do expect the relative prices to soybean oil and to corn, so the representative feed and bio demand, to be higher than usual this year, higher than history would suggest they would be. And that's purely based on LCFS credit value, the tax credit being in place, and a long runway of certainty in the renewables market, lending strength to those markets that we haven't seen over the last couple of years. I'll go back to you, George.
All right, sounds good. Now's the time. If anybody has additional questions, drop them in. We have a few here that we'll start with. Really, I guess the first one here we'll start with is you, Cusick. Renewable diesel is now at 34% of D4 RIN generation, and it appears the shift away from bio to renewable diesel will continue as new renewable diesel and CP projects. Can you clarify that a little bit more?
Yeah, so I think the question, I guess, is asking, with the recent EMTS, as Tori just touched on, we're seeing renewable diesel D4 RIN generation surge. And although it's not necessarily at the expense of biodiesel yet today, I think the question is longer term. There are new renewable diesel projects, and I think you said CP co-processing, but they're not new biodiesel projects being announced presently in the United States. So prospectively moving forward, right, we're going to see more and more D4 generation come from these new processing. And I think the other thing we're seeing, the really early signs of, which I think the question's touching on too, is as renewable diesel, and namely what we're starting to see in the sort of co-processed renewable diesel RIN generation is D5 RINs. So I think it begs this question, and Tori, I might kick it to you, but we're seeing D5 RIN generation now. We're seeing sugarcane ethanol come into the California market to do it, and now we're seeing what's being called by BP on their website co-processed renewable diesel. And we believe a couple of now streams of material is now generating D5 RINs. So prospectively, the feedstock's now going to move towards D5 RIN generation as well as D4. And that is a new development, certainly. And at present appears to be headed and trending in that direction. Tori, I think you'd agree.
Yeah, absolutely. And I think the thing to remember about this trend is that as you take up D5 RIN generation, you actually lower the need for D4 RIN generation, because there's some amount of the total D4 mandate that comes from the undifferentiated advanced biofuel requirement, which is essentially the total advanced requirement minus the sum of the components of the total advanced requirement. And so as that D5 production kicks up, it reduces the need for D4 production. Now, typically, I think from a feedstock perspective, you might think that this is probably not as good for soybean oil. I think that would sort of be the traditional way to think about this, because or a lot of the D5 generation, as John said, came from sugarcane ethanol imports. But as you increase the co-processing and D5 generation, these big plants in these major refiners aren't going to use used cooking oil or some of the lower CI feedstocks, because they need a consistent supply and a lot of supply, and a supply that can be expanded. And so while typically I think you would think of lowering the undifferentiated advanced requirement is bad for soybean oil demand in the longer term, I actually think it's probably bullish to really bullish for soybean oil in the longer term.
Yeah, and I'd agree. I think we're even seeing early signs of these new projects as they're starting to come to market. Timelines are being formalized. There's a lot of refined virgin veg oil, soybean oil that's going to be headed into those projects. I think that's a safe bet.
And Cusick, can I interject? I got another question here for you, Tori. Speaking of soybean oil, you lowered your projections pretty aggressively. What's your thinking behind that?
Yeah, so I actually set my projections on Monday, and then I went back this morning and I cut them quite a bit. Part of it is just kind of a little bit of market action. I thought that prices would stabilize after a pretty big drop on Monday. But if you look at what's going on in palm oil actually fell 4% overnight. And while the spread between soybean oil and palm oil could certainly absorb a larger fall in palm oil relative to soybean oil, I think what the palm oil market is reacting to is the spread of the coronavirus in Asia and around the world, and the potential for that to slow down the demand for world vegetable oils. Now, the marginal demand in the U.S. for soybean oil is mandated, right? It comes from the RFS program. But if you get a decline in exports, and if you get a decline in the U.S. economy, you get a decline in the actual non-biofuel demand. And I think that the futures market is probably going to price that in. I think it's probably going to overreact to some extent too. And so I think it probably goes lower. I think on the cash side, I think you probably see basis levels start to rise a little bit more aggressively as the futures market continues to move lower. And so on the cash side, I don't see the decline over the next couple of months to be as aggressive as I do in the futures market. But then right now, what we're projecting is a recovery and a recovery back to sort of the levels that we were projecting by late summer. We'll see how that goes. Like if the coronavirus is much worse than I think people are expecting right now, we probably are going to have to lower those forecasts as well. But for right now, based on what we know and what's going on, I think this is probably a couple 2, 3, 4 month kind of issue. I kind of hit the projections pretty hard in the next couple of months, and then let them start to come back a little bit. I think that's how it's going to work right now, but stay tuned.
All right, thanks, Tori. I'm also going to stick with you on this one. Why is there such a big difference between the USDA balance sheets and the Jacobson balance sheets for 2021?
So part of it is where the USDA starts their balance sheet. So the USDA uses last fall's balance sheets to start to build their forecast for the outlook for them. So part of it is just kind of that the information's a little bit old. Not that there's been that big of a change in what's gone on in the soybean oil marketplace or in our balance sheets since then. But I think the bigger part of it has to do with something that we kind of touched on a little bit last week. And while these forecasts aren't generated in the same way that the long-term forecasts are, there still is this difference in how the USDA treats biomass-based diesel forecast and renewable diesel forecasts. And I don't feel like they necessarily have a great handle on what may be coming at the market later this year. Like John said, we're already starting to see anecdotal reports have indicated that some of the major refiners are starting to cover their needs for test runs for later this year. And I think that as that co-processing demand starts to come on, I think that there's probably I think USDA is going to have to raise what they now have we call non-biodiesel demand pretty significantly as we go through the year and as we get closer to the 2021 marketing year. I think that if they would split that out, I think everybody would be a lot happier if they would actually have sort of a real biofuel or a real or have a biodiesel and then renewable diesel and co-processing. I think if they split all that out, everybody would be a lot happier with everything. That's just my personal opinion. We'll get the first sort of real look at the USDA's 2021 balance sheets in the May WASDE report. That'll be the first time that they're not generated primarily through sort of econometric models. There'll still be a little bit of that, but that'll be sort of the first time that we get the kind of a look at the kind of balance sheets that we're sort of used to looking at from the USDA.
All right. I think we got time for one more question. Cusick, this one looks like it's for you. What's next for the D4 near term and longer out into the year?
Yeah, I think we remain sort of near term a little bullish. We think that there might still be some more SRE news that's sort of supportive of the whole RIN complex right now. Obviously, the spread right now is a bit tricky with the whole coronavirus macros, but it's sort of putting pressure across the board downwards. So from the spread, it's not sort of potentially going to jump one way or the other too aggressively. We've got the EMTS sort of passing by, so we still believe that constructively that there's some movement in the D4 RINs across the coming weeks. Obviously, these macros with the coronavirus, the big kind of variable right now to consider. Longer term, we maintain and continue to see some sort of through March Q2 constructive movement tied and in relation to the spread. Certainly we're saying that we may see feedstock prices start to move as some of these projects come in. Therefore, we're seeing more and more RIN generation across that Q2 summer period. So we're still thinking we may see things fall off there in the Q3 timeline as some big EMTS numbers start to lock in, especially after seeing Jan. I guess the big question mark we're now thinking about on that front is how this whole D5 feedstocks going in and creating D5 RINs longer term versus D4. And I don't think we're going to see that happen too quickly, but it's kind of the longer term thing we'll need to watch now. So for this year, I think we remain sort of constructively bullish near term. We still expect a little further down the curve in Q3 for a lot of what we see robust production to catch up with things, put some maybe downward pressure on RINs. And then we'll be watching DC and the elections closely, of course.
All right. Thank you, John. That's going to wrap us up for this week. If anybody has additional questions, please feel free to email me, george@thejacobson.com, or jump on the next week's webinar and drop your questions then. Ryan, John, Tori, thank you today for your contribution, and attendees, thank you for joining in on the call.
Thanks, everybody.
Thanks, guys.